Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamelin. If you're tuning in for the first time, this is your go-to podcast for all the latest developments, trends, and regulatory changes affecting the mortgage and real estate industry in Ontario. We dive deep into the numbers and provide you with insights sourced from reputable news outlets to help you make well-informed decisions. This is episode number 90, and we've got a jam-packed show for you today. Let's kick things off with some substantial news. The combined value of Ontario's real estate is now estimated at a staggering $3.14 trillion. Yes, you heard that right, $3.14 trillion. This data comes from the Municipal Property Assessment Corporation. It's a significant increase from last year's valuation, which was already an impressive $42 billion. One of the key factors contributing to this rise is new construction projects. For example, new developments at sites like 407 Dundas Street West in Oakville have played a crucial role in boosting the overall value. These projects are not just adding to the residential market, but also enhancing commercial spaces, making Ontario a more attractive place for both living and investing. Toronto, one of Ontario's most vibrant cities, has also seen a notable increase in property values. The city's real estate value has climbed to an eye-popping $9.93 billion. This surge is reflective of the robust demand for both residential and commercial properties in the area. Toronto continues to be a hotbed for real estate activity, attracting investors from all over the globe. The Municipal Property Assessment Corporation's report is a treasure trove of insights. It breaks down the value assessments across different regions, giving us a comprehensive look at how various factors are influencing the market. From urban centers to suburban areas, the report covers it all, providing a detailed picture of Ontario's booming real estate landscape. So, what does this mean for you? Whether you're a homeowner, investor, or a real estate professional, understanding these valuations is crucial. It helps you gauge the market trends, make informed investment decisions, and even negotiate better deals. The data underscores the importance of staying updated with the latest market assessments to navigate the ever-changing landscape effectively. As we prepare for a wave of mortgage renewals in 2025 and 2026, there's significant news that brokers need to be aware of. The National Banking Regulator, the Office of the Superintendent of Financial Institutions, has announced that homeowners with an uninsured mortgage will no longer need to undergo a stress test when switching lenders at renewal time. This decision comes after feedback from the mortgage industry about an imbalance between insured and uninsured mortgage renewals. It's a big win for brokers gearing up for this renewal wave, according to industry experts. Sushanta Sen, the Director of Sales at MCAP, highlighted this change at the Canadian Mortgage Summit, calling it a huge opportunity for brokers. Sen stressed the importance of establishing early contact with clients, even sooner than the traditional 90 days before renewal. The roads ahead are going to be very different than what happened in the last 12-18 months, Sen said. Interest rates are going down, that's for sure. Depending on which economist you follow, there are various predictions out there to the point of even talking about another 1.5 to 2 points in rate reductions by next fall. Early contact is crucial, especially given that most borrowers will face mortgage renewals at rates much higher than their initial contract rate. Sen emphasized the need for brokers to have clear conversations with their clients to prepare them for elevated monthly payments. When you get to them early, first of all, be you, he said. Consumers, your customers, want to talk to you about their budget, about the shock, the increase in the payments that's going to happen. Many can withstand that, but they need your help. They need your guidance so that when it comes up for renewal, be it 3 months, 6 months, a year, or even 18 months, they know that they're on course. The biggest missed opportunity out there is not getting to them soon. Agostino Tuzzi, the Vice President of Credit at IC Savings, also spoke on the same panel. He mentioned that brokers have faced a really tough market recently, but noted the opportunity to position themselves as indispensable sources of information for borrowers. Payment shock is real, he said, and they need to be able to turn to somebody to get them through that. This is a real opportunity. You've got a captive audience in these borrowers to really be that trusted advisor, help them through this storm, and build a long-lasting relationship. One of the most important components of maximizing this opportunity, according to Tuzi, is effectively mining their databases to identify which clients need assistance. He described these databases as gold and emphasized the importance of using them wisely. Rounding out the panel was Shail Rothman, the president of realestatelawyers.ca. He pointed out common missteps made by brokers in the mortgage process, often starting with not taking the right approach to a client. Whether you're a newbie or you're a seasoned professional, you've been doing thousands of deals, or it's your first one, don't treat the clients as a number, he said. Treat them as if it's your first deal. Treat them as if it's your only deal and your reputation depends on it. The reason I'm saying that is as soon as it starts flowing through the transaction, everything has a ripple effect, and you need to realize that if there's outstanding broker conditions, it's garbage in, garbage out. So you need to manage the expectations of your clients. Rothman noted that failing to manage client expectations can lead to frustration and delays at closing, whether for a purchase or refinance. We try to buffer things, but if there are outstanding broker conditions, there's no way for me to massage it, he said. If we can't get a hold of the broker, I have to get the client involved in order to close those transactions. Your reputation is everything. Minimize the stress for a client. Try to get your documentation in as quickly as possible so that you're not the holdup of a transaction. Markets are increasingly betting on the Bank of Canada delivering a 50 basis point rate cut during its October 23rd policy decision, with the odds now sitting at around 53%. Even if the bank does not opt for a supersized rate cut later this month, a smaller quarter-point cut is virtually guaranteed, experts say. That would mark the bank's fourth consecutive rate cut since it began easing rates in June. The Canadian economy continues to grind out sub-potential growth and, with inflation back at the 2% target, talk of more aggressive easing continues, wrote BMO senior economist Robert Kovcich. Despite July's gross domestic product growth coming in slightly above expectations at 0.2% month over month, Desjardins economists believe this modest gain will not be enough to derail a potential 50 basis point rate cut by the Bank of Canada. Economists LJ, Valencia, and Randall Bartlett emphasize that real gross domestic product gains continue to lag behind population growth, with output per person declining in 7 of the last 8 quarters, a streak not previously seen outside of a recession. In all, a solid headline GDP gain in July doesn't change our call that the BOC will likely proceed with a 50 basis point rate cut in October, they wrote in a recent report. Easing inflation, ongoing labor market weakness, below-trend real GDP gains, and more per-person economic weakness provides a strong case for further monetary easing. Even if the Bank of Canada opts for a smaller quarter-point rate reduction, Kovcich notes that this does not change the broader outlook. The bigger picture is that we're on a quick path back to rates that are closer to, if not slightly below, neutral, he wrote. In other news, Neo Financial has been named Canada's fastest-growing company. Calgary-based Neo Financial secured the top spot on the 2024 report on Business List of Canada's top growing companies, posting an incredible 3-year revenue growth of 38,431%. Founded in 2019 by the co-founders of Skip the Dishes, Neo has quickly gained traction, now serving over 1 million customers and growing its team to 750 employees. Neo Financial collaborates with top financial institutions to deliver a range of financial products, including credit cards, savings accounts, investment services, and mortgages. Last year, Neo ranked first in Deloitte's 2023 Technology Fast 50 Companies to watch list. In a social media post, co-founder and chief executive officer Andrew Chow said, "Just over 4 years ago, we started Neo Financial with a simple but bold mission: give Canadians more choice when it comes to their finances." This is not just a win, it is a testament to our team's relentless hard work and the trust Canadians have placed in us, he added. Growing at this pace does not happen without grit, tough calls, and a laser focus on what really matters, putting our customers first. Here's a look at some of the other names that stood out as Canada's top growing companies this year. Blurroot at number 103. CRM products for mortgage brokers and financial advisors, with a 3-year revenue growth of 393%. CMI Financial Group, at number 119, offers lending and wealth management services with a 3-year revenue growth of 353%. Amber Financial Services Group, at number 188, mortgage investment corporation and private equity financing with a 3-year revenue growth of 228%. Pineapple Financial, at number 242, tech-focused mortgage brokerage with a 3-year revenue growth of 166%. Access Law, at number 356, national real estate and mortgage closing company with a 3-year revenue growth of 84%. Home Equity Bank, at number 399, provides reverse mortgages with a 3-year revenue growth of 64%. Forbes Advisor recently highlighted several top mortgage lenders in Canada for 2024, recognizing those offering competitive rates and strong customer service. Among the standout names were Nesto Incorporated, Bank of Montreal, Equitable Bank, Haventry Bank, TD Bank, Bank of China Canada, IG Investment Management Limited, Think Financial, First Nations Bank of Canada, and MCAP. Forbes reviewed 100 mortgage lenders across Canada, evaluating factors like interest rates, loan options, prepayment privileges, and customer service. Only lenders operating in at least 4 provinces and displaying their rates online were considered. The rankings prioritize affordability, accessibility, and key features that impact the home buying process, with interest rates weighted most heavily. Other criteria like broker privileges and timeliness also influence the scores to reflect what matters most to consumers when comparing mortgage lenders. Canada's national mortgage arrears remained stable at 0.19% in September, according to data from the Canadian Bankers Association. This rate, which tracks mortgages that are 3 or more months overdue, has hovered between 0.18% and 0.19% since December. In practical terms, this translates to 9,640 mortgages in arrears out of over 5 million total mortgages. While the national arrears rate has edged up from a low of 0.14% in 2022, it remains well below the pandemic high of 0.27% seen in June 2020. Moreover, Canada's arrears rate remains significantly lower than that of the United States and United Kingdom, according to the Canadian Bankers Association. Regionally, Saskatchewan leads with the highest arrears rate at 0.57%, slightly down from a recent high of 0.60% in January. In contrast, British Columbia and Ontario maintain the lowest arrears rates at 0.16% and 0.14%, respectively, with no recent changes in those provinces. Sagan has unveiled updated new-to-Canada mortgage documentation requirements. Mortgage insurer Sagan has introduced a streamlined documentation process for individuals who have immigrated or relocated to Canada within the last 5 years. The update aims to simplify the mortgage insurance application process, making it easier for newcomers to access homeownership in Canada. National Bank of Canada has received a key regulatory approval, allowing its $5 billion all-stock acquisition of Canadian Western Bank to move forward. The Montreal-based bank announced that the Competition Bureau has cleared the transaction. However, the deal still requires approvals from the Office of the Superintendent of Financial Institutions and the Minister of Finance. Earlier this month, Canadian Western shareholders voted to approve the acquisition. Private mortgage lender CMI Financial Group says it has surpassed $1 billion in mortgage assets under administration, a milestone it says underscores the growing popularity of private lending in Canada. Private lending plays a crucial role as a complementary market, offering transitional solutions for borrowers who may not meet traditional lending criteria, Chief Executive Officer Brian Jaskolka said in a statement. As we continue to expand our portfolio and enhance our offerings, CMI remains dedicated to bridging gaps in the financial landscape, providing flexible and accessible borrowing options to mortgage brokers and their borrowers, as well as compelling opportunities for investors. New data from the federal government shows that insolvencies reported by Canadian households and businesses are stabilizing. Bankruptcy and Insolvency Act insolvencies totaled 11,800 in August, a decrease from 12,202 in July and below the 6-month average of 12,194. Of the total insolvencies, the majority, 11,388, were filed by consumers, consisting of 2,367 bankruptcies and 9,021 consumer proposals. BMO notes that bankruptcies remain historically low, suggesting lenders are working with borrowers to ease the original terms of the agreement. While Canada is grappling with an affordability crisis, the Global House Price Index reveals that many developed economies are facing similar issues. Since the fourth quarter of 2019, global home prices have increased by 30%, though growth has slowed since central banks began raising interest rates. In contrast, disposable incomes have only risen by 20% over the same period. According to BMO, although Canada's home price increases have outpaced income growth, the gap is even more pronounced in countries like Australia and the United States. Spartan Fund Management has teamed up with Capital Asset Lending Incorporated to launch a new residential mortgage fund aimed at retail and institutional investors. The Capital Asset Income Fund, or CAF, offers access to Capital Asset Lending's portfolio of residential mortgages, allowing investors to tap into the growing market of private mortgage lending. The fund primarily invests in mortgages managed by Mortgage Company of Canada Incorporated and First Mortgage LP. Both Mortgage Company of Canada Incorporated and First Mortgage LP cater to borrowers who have solid credit scores, but fail to meet federal income requirements for traditional bank or trust company loans. These borrowers often include individuals who fall short of stringent qualification criteria despite being creditworthy. The fund will offer several classes of units, Class A, Class F, and Class Y units, available to accredited investors or qualified purchasers. Potential investors are encouraged to review the fund's offering memorandum and consult with their financial advisors. We are pleased to add KF to Spartan's alternative investment lineup, Spartan President Gary Ostowich said in a joint press release. Capital Asset Lending is one of the major players in this sector, and we are excited to offer a residential mortgage fund to retail and institutional investors. We are thrilled to be working with Spartan, one of Canada's leading providers of alternative investment solutions, to bring this new vehicle to market, added Raj Babur, Chief Executive Officer of Capital Asset Lending. Spartan Fund Management, established in 2006, is based in Toronto and manages more than $1.8 billion in client assets. The firm specializes in alternative investment solutions for high-net-worth individuals and family offices. Capital Asset Lending, founded in 2009, provides mortgage origination, underwriting, and administration services, and is licensed as a mortgage administrator in Ontario. Mortgage Company of Canada Incorporated, which has been in operation since 2013, is one of the largest private mortgage investment corporations in Canada, with over $1 billion in assets under administration. First Mortgage LP, launched in 2021, focuses on first mortgages in Ontario, with plans to expand into the Greater Vancouver area. In other news, Pineapple Financial Inc. has once again made headlines. The tech-driven mortgage brokerage has been named among Canada's top-growing companies for the second consecutive year, boasting a remarkable 166% growth over the past 3 fiscal years. This ranking comes from the Report on Business by the Globe and Mail, which evaluates Canadian companies based on their 3-year revenue growth. This achievement highlights Pineapple Financial's ongoing success and resilience in an increasingly competitive market. The company has solidified its position by leveraging cutting-edge technology, empowering mortgage professionals, and expanding its presence across Canada. CEO and founder Shubha Dasgupta expressed immense pride in this recognition, stating, "This underscores our team's unwavering commitment and perseverance, even amidst high interest rates, inflation, and subdued consumer sentiment." Pineapple Financial's innovative approach includes tools like Pineapple One, Maui AI, and Doc Genius, which have been instrumental in driving its growth. President and COO Kendall Marin emphasized that their excellence in technology and relentless drive to push boundaries have solidified Pineapple's position as a key player in the Canadian mortgage industry. Canada's Top Growing Companies list, launched in 2019, aims to spotlight the achievements of innovative businesses across the country. The ranking is based on a rigorous multi-stage application process that includes providing detailed financial reports and meeting strict growth criteria. This year, 416 companies made the prestigious list, with Pineapple Financial standing out as a pioneer in the mortgage industry. In conclusion, Pineapple Financial's inclusion in the Globe and Mail's ranking for the second year in a row is a testament to its resilience, adaptability, and continued innovation in the Canadian marketplace. As the company continues to navigate the evolving financial landscape, it remains committed to helping more Canadians achieve their home ownership dreams. That's all for today's episode. Thank you for tuning in to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamilton. Stay informed, stay ahead, and we'll see you next time.